consumers displayed some optimism already like November, December, and then slowly this year it deteriorated, and we had a massive deterioration in April. It's pretty scary because you see that we still have 2/3 of consumers that are expecting a recession.
Today, we're diving into economic data, consumer confidence, and leading economic indicators by the Conference Board. It's a research organization that produces economic indicators that are widely considered by mainstream economists to be one of the definitive indices for forward-looking economic growth projections. These indicators offer crucial insights into where the economy is currently at and where it's headed. And I'm pleased to be joined today by one of the architects of the indices, Stephanie Guichard, senior economist for global indicators at the Conference Board. Welcome to the show, Stephanie. Good to have you here.
Yeah, thanks. I'm very happy to be here.
Let's start by talking about the latest numbers. Consumer confidence for July, as published by the Conference Board. I'll pull up these numbers here. If you take a look at my screen, you'll see that in July, the Conference Board produced numbers that showed some improvement in the consumer confidence. So it improved by 2 points to 97.2, up from 95.2 in June. However, it still rests below last year's consumer confidence level. Meanwhile, the present situation index, it's based on consumers' current assessment, fell by 1.5 points, while the expectations index, which is a forward-looking index, rose by 4.5%. 4.5 points, rather. So before we get into the details, just give us a summary of the current situation. How strong or weak is the economy based on these numbers?
So, and maybe you should show the chart as you were showing these numbers. I think this is, this is kind of showing it was really a roller coaster this year for consumers. So confidence reached a peak at the end of last year. It was, consumers displayed some optimism already like November, December, and then slowly this year it deteriorated, and we had a massive deterioration in April. Right after, Liberation Day, people started to get extremely worried about prices and the impact of tariff on prices. And how do we know that? We know that because not only we do the survey, but we ask consumers, what is driving your view of the economy? And it was really the thing that came on top of their mind. Since then, so it recovered in May, but now it's very stable, and it's stable a bit below the low points of the past 2-3 years. So I would say, consumers are very cautious, and it's important for the U.S. economy because, consumption was driving GDP, and we haven't seen a massive slowdown in consumption. But when consumers are worried, there is a chance that, they may be more cautious about their spending going forward. So that's where we are, and it's kind of a wait and see situation. There is no super clear direction, and I think that's fair to say. It's kind of in between.
Historically, how accurate has this consumer confidence index been in predicting actual consumer spending in the economy?
So what it does is it helps predicting consumer spending for a given level of employment, a given level of income, a given level of interest rate. So, consumption is driven by what consumers have in their pockets and whether they have a job or they are worried about losing their jobs. And so once, you need to think about when you forecast consumption, like what are the core drivers of consumption, okay? And everything else being given, if consumer confidence is low, they're going to be spending less. If consumer confidence is high, they're going to be spending more. So this is how it plays. So you don't have a one-to-one match between consumer confidence and consumer spending, but consumer confidence helps you to refine and brings you more information about what consumers are going to be doing given the current environment. So I would say, everything being equal, if consumers were super optimistic, even for the current income they are getting, they would be spending less. If they were very pessimistic, if they were super optimistic, they would be spending more. Very pessimistic, they would be spending less. at this point, they're kind of in between. So it's really a wait and see, but you need to dive into the components to see a bit more what is driving the assessments of the economy, I think.
Yes, let's talk about that. So let's talk about the components. Are you surprised, first and foremost, that despite tariff uncertainty and the ongoing trade wars that are still happening around the world, this consumer confidence index has been seeing an uptick?
So we saw the uptick is very interesting. It started after May 12th and the deal between the US and China. And we know that because when we did our May survey, we collected data for the whole month, and we had May 12th kind of in between the sample. So we were able to see that there was a faster improvement in consumer confidence after May 12, when they realized that, there was this de-escalation of trade tension between the US and China. So this has clearly helped pushing consumer confidence up after the big worry of April. However, it has stabilized because they are still very concerned.
Okay. I want to point something out here. So let me just pull this up once more. So we're looking at right now at the consumer confidence index, which, as you can see, has been ticking up slightly. However, if you take a look at the U.S. leading economic indicator, that has been steadily falling. And so why is it that the leading economic indicator, which factors in a lot of components, including trade sales, industrial production, among other components, payroll, employment, personal income, why has that been falling at the same time as consumer confidence slightly improving? Can you explain this disconnect here?
Yeah, so consumer confidence is part of the index, but it's and if you go down, you have the breakdown of the different components. So you're going to see one that is called average expectation of business conditions. So it's taking the expectation component of our index. So it's one of the subcomponents. And it's also not only taking ours, but because we wanted to make sure, we have a broad view of the economy, it's also taking into account the Michigan survey and their expectation index about business conditions. For both surveys, this has been very low. So basically, there is no discrepancy between the two. When you look about our consumer index, it has 5 components. The business condition is one of these components. It has been weak for some time, and you can see in this chart that this is one of the indicators that is pulling down the US LEI. Another indicator that is pulling down the US LEI are the orders in the manufacturing sector. And this is not surprising because of the tariff situation and the worry about, world trade, global economic growth. And we saw that the manufacturing sector, which had rebounded in recent months, is taking a hit again. So this, if you look at especially, the last publication, these were the drivers. And then if you look historically for the past 6 months, it was again these 2 drivers, consumer expectation and manufacturing orders.
Okay. One more question on the LEI before we move back to the consumer confidence indicator. So the recession signal is indicated by these horizontal red lines here. That's been triggered several times since 2023. So why no official recession?
Well, because first, one of the indicators that has really pushed the LEI down, which is not the case anymore, but in 2023, 2024, is the yield spread. So, the difference between long-term rates and short-term rates. Historically, this was the magic indicator to predict a recession. And remember, 2 years ago, when the yield curve inverted, everyone started to talk about a recession. It's one of our indicators, and this one has been really putting an indicator down. So that's okay. So this one failed. There was no recession, but traditionally, when the yield curve inverts, you get a recession. The other thing is our indicator is heavy on manufacturing. So especially, we have the manufacturing orders, and I think, there was a manufacturing recession, but there was no service recession. So there was no recession for the economy overall. However, what our indicators captured was that, the manufacturing was in trouble in 2023, 2024. It came out of trouble end of 2024. I think it may be back there now, but so this is captured by our indicators. This is the way it was built. Service sector is very difficult to capture with macroeconomic data. This is something we're working on, but so far, it captured more the manufacturing recession. And if you have very concerned consumers, because consumer expectations have been very weak in 2023, 2024, and on top of that, you have a negative yield curve. This is what has driven our index.
Okay. One interesting note regarding inflation I'll bring up. It says here, according to this report, that consumers' average 12-month inflation expectations eased slightly to 5.8%, down from 5.9%. Well, that's still significantly higher than what we currently have. Are these expectations realistic?
Okay, so consumers' expectations for inflation are always higher than the CPI, and what you need to realize is, the CPI, or even the PCE, the indicators we are following, they are built on baskets of, everything that the consumer is buying. But consumers, the basket they think about when you ask them about inflation is more something that's, is the price they see on the day-to-day basis. Is when they go to buy gas, when they go to buy eggs, when they go to buy groceries, they think about these prices. They basket, the way they think about inflation is different from our index. So and the gap has existed historically. It's just that they are not thinking in terms of CPI. They're just thinking how much I pay today when I did my grocery. And this is affecting their expectations.
Okay. Well, again, these expectations for inflation, have they historically been accurate in projecting the direction of inflation? So let's say consumers are expecting 12-month inflation to fall slightly. Does that historically mean that inflation will actually fall slightly?
Not necessarily, because these are very adaptive expectations. So it's more based on how much they are paying than how much they expect to pay. That said, it brings some information because, if consumers are worried about prices, this is very important when you relate it to their spending behavior. And when there is a shock, when there is a shock to the economy, they may anticipate a gas price shock. They anticipate the impact right away. In this type of circumstances, there is a great correlation with what's happening to inflation afterwards, because they know that historically, when you have an energy shock, then they're going to get more. They're going to pay more when they go to the gas stations. And then this is going to be reflecting the CPI too. So it works both ways. So part of it is adaptive expectations, and part of it is they see what's happening in the economy, and it also helps anticipate what's going to happen to inflation.
Okay, this is interesting, and this is something that I think a lot of my viewers would be interested in knowing. July consumers' outlook on stock prices rose from April's 16-month low, 47.9% expecting stock prices to increase over the next 12 months, up from 37.6% 3 months ago. What's contributing to this higher bullish sentiment, Stephanie?
Well, it's the recovery on the stock market. Again, consumers, when they form their stock price expectations, they look at stock prices today and they, it's going well. They also follow the news. So they follow earnings, at least the ones who have stocks, they follow earnings. And it's, they see the improvement in the stock market. And it's also, the whole discussion about tariffs. They saw that it's not as bad as what they thought, because April was already a low point in terms of consumer stock prices expectations. And since then, the situation has improved, so they started to reverse the expectations about stock prices. They are not back where they were earlier this year. At some point, we reached a record high in terms of consumers expecting stock prices to increase at the very beginning of the year, and but it has weakened since then. So it's how they view the economy, what they see in terms of stock prices, and then they listen to the news.
Okay, that makes sense. A special question asking consumers about the direction of various interest rates suggested that they largely believe mortgage rates, auto loan rates, and credit card rates were more likely to rise than other types of interest rates. That's interesting. The expectation for the Fed funds rate, at least, is that the Federal Reserve will likely keep rates unchanged, if not lower rates for the remainder of the year. So I'm wondering why consumers are, at least in this survey, expecting consumer rates to rise.
They also expect the Fed rates to rise, by the way, but not as much as those rates. So they are kind of in the same.
They expect the Fed to hike rates this year?
They see all the rates moving in the same direction, but more of them are seeing these rates increasing. And this may be due to the real concern they have about the impact of tariff on inflation. And so, but because they know that, if tariff results in higher prices, they are more likely to see an increase in interest rate than a decrease. And it's a concern. And it's also, when you think about the mortgage rate, the auto loan rates, the credit card rates, it's also a concern that, maybe about their financial situation, maybe a deterioration in their credit score. They're going to be paying higher rates, even even if the Fed doesn't increase rates, they may be asked to pay higher rates because their credit scores are deteriorating. And this is something they take also into account.
This is important. Purchasing plans for cars and homes declined in July. Dining out was also one of the categories seeing the largest decline in spending intentions in July, along with transportation and lodging related to personal travel. Consistent with these findings, vacation intentions were also down. When consumers spend less on discretionary items like cars, vacations, dining out, Stephanie, is that usually an indicator for an economic slowdown? A leading indicator, that is?
It could be. I mean, it means that it shows that they are stressed. So when they think about cutting discretionary saving, it means that they are stressed. However, the real test is whether they're going to start with when they start cutting on non-discretionary spending, because this is when the economy is in really bad shape. Is when you start cutting on the things that you really need.
Like food at home, for example.
Yeah. For instance, when you start, to say, I'm going to try to cut on, healthcare, food at home. We have some other examples of, I don't.
Are you seeing any evidence of that happening? Consumers cutting down on things that usually have a inelastic demand?
No, we don't see it now. We haven't seen it. I mean, we don't see it in spending intentions.
So just going back to these discretionary items here. So if they plan to spend less of that, why are they worried about their spending? Because like we talked about earlier, inflation expectations are coming down and confidence is up a little bit. So I'm just curious why, even though confidence is slightly up and inflation expectations are down, people are still expecting to spend less money.
So you need to, you are thinking in terms of small changes, but you need to look at the big picture. So overall, yes, consumer confidence is up, but it's lower than what it was last year. Okay. Inflation expectations are slightly down, but they are higher than they were a year ago. And overall, so consumers are more concerned than they were a year ago. And so when you ask them, are you going to spend more going out, going on vacation? They say no. That said, it has happened last year that they tell us, no, we're going to be saving because we are worried. And when you look at the consumption data, they're still spending. And, As economists, we are always surprised by how much the U.S. consumers are spending. As long as they have a job, as long as they have an income, typically they spend. Even if they tell you they're not going to spend, at the end of the day, they still open their wallet. So that's the upside risk to everything here, is that these are intentions, this is confidence. They may still continue to spend.
Right. So what are their expectations for employment? Are they expecting to keep their jobs? Are they expecting any changes to their wages? And for those out of the labor force, are they expecting to find a job anytime soon?
So the way we ask the question, there are two questions that are related to that. The first one, we're asking consumers, going forward, is it going to be easier or more difficult to find a job? And on that one, they're really pessimistic. So they think that it's going to be more difficult to find a job 6 months from now. Okay? So, and when they answer this question, they think about themselves, they think about their kids, they think about their relations. If they, about people going to the job market, or even they think, okay, if I quit my job today, it's going to be more difficult for me to find a job than it was a few months ago. If I quit my job in 6 months, okay, maybe I would struggle to find something else. However, when we ask about the second question, what do you think about your income 6 months from now? They are positive. So they think that the labor market is going to deteriorate. They think that people looking for jobs are going to struggle more to find a job. However, they don't seem to be very concerned about their own income, which means that they are not very concerned about their own jobs. So for now, they are not worried about losing their jobs. And that's very important, because in April, when we saw this dramatic collapse in confidence, the income indicator went negative. So in April, when everyone panicked, they thought that, okay, there is a chance I'm going to lose my job, which was reflected in pessimism about future income. It didn't last. They are back in optimism territory. So they're not worried about losing their job. They just think that, the labor market is going to be less robust than it is currently. And if you are on the market for a job, it's going to be more difficult.
Yes, this is the current financial situation for families. Can you help us evaluate families' current financial situation now in 2025 versus a few years ago? How has this changed?
So, and this is an indicator that we put out in 2022. So we don't have, the whole history we have for the other ones. We don't have the same. We don't know what's the bottom and we don't know what's the high point. But over these 3 years of data, what we see right now, they're quite optimistic. I mean, they're quite happy about their current financial situation. It's not it's among the high points that you see on this picture. If you look at the yellow bar, which is the difference between the two lines, so it's positive and it's relatively high. It includes, what they think in terms of their income, but also potentially their stocks. And so far, so good in terms of their current family financial situation.
Right. And just going back to what we were talking about earlier about recession likelihood and probabilities, I wonder if this is a coincident indicator with other things. The likelihood of a recession, perceived likelihood of a recession, has been coming down. Certainly there's been less interest of recession talks on media.
Yes.
So I'm curious to get the actual assessment, and I'm curious how this relates to the LEI. Like I mentioned, right, the recession indicator has been flashing for quite some time, but yet, like this indicator and other indicators show, people are less concerned about it. So, can you explain this discrepancy here between this and that?
So again, this one is a recent indicator. So we don't have the full history that you can see on the LEI chart. What we focus on are the changes. So if you focus on the level, it's pretty scary, because you see that we still have 2/3 of consumers that are expecting a recession, which, and it's been above 60 since we started to ask the question. So you could say it's high, it's very high, and it's completely in line with the LEI because both of them are talking about recession. But that's not the way we interpret this data. So we see it as, an indication about concerns about the economy in general. Recession talks, of course. So when everyone started to talk about a recession in 2023, it spiked. Then the recession talk slowed, went down. And we see it again. People started to be concerned about a recession when the discussion about the tariffs came back. And then it increased, it spiked in April, and since then it has slowed down. It's still higher than last year. This is really consumer sentiment. And it's a very different indicator than our LEI.
To what extent is this a sort of a self-fulfilling prophecy, so to speak? So if, let's say, a majority of consumers surveyed, like 2/3 in this case, expect a recession, and they also expect to spend less on big ticket items, does that not cause a slowdown? Because if they expect it, they spend less, and then that causes the slowdown? Yeah.
If it was the case, we would have had the recession in 2023, 2024. It didn't happen.
Sure.
That's the first
Yes.
thing. The second is, and again, that's when you ask the consumers this type of question, yes, the world everything is bad. I'm concerned, I'm worried. But then when they go to the store, they open their wallet. It's kind of two different persons answering the survey and going to the store. So I don't think, especially on this recession question that is relatively new and on which we don't have so much history, I wouldn't take it as, especially as some, auto-realizing expectation.
So we've talked a lot about consumers' confidence. I'm curious what CEO confidence is like and how they compare to consumer confidence.
So we have the CEO survey. It's quarterly, so we don't take the pulse of CEO every month. We just take it every quarter. If we look at this year, so we did our first survey in February. They were extremely optimistic, like the most optimistic they had been for a few years. Then we did our second survey in May. And then they were the most worried they had been in the past few years. And we just published the third one of the year last week, and it kind of stabilized at a neutral level. So basically, they went from super optimistic to super pessimistic to kind of neutral and cautious. And I don't know if you have the charts here that you could display, because we were just talking about recession, and in our press release, we also show their recession expectation, and it's jumped to over 80% in May, and now it's back to 35%.
Yeah, we can look for that chart and put it up later. So I wonder why there's been this big disconnect between how CEOs feel and what consumers feel. Is it simply because CEOs are more wealthy? Is that the only reason?
No, we are CEO about their business. And I don't think there is a disconnect. I mean, they both decline a lot in May. Consumers in April, CEOs in May, because we didn't do any survey between February and May, so it was the low point, and they are both recovered. And they are both recovered to a level that is better than the low point, but not as high as last year. So I think they are kind of, I would tend to think, if you accept that we don't do the CEO survey every month, so we don't have, the same time series, they kind of track each other, and they are both in a very kind of cautious wait and see mode, both the CEO and the consumers. It's not as bad as earlier in the spring, but it's not as good as last year.
Okay, one new development, it's not new, but it's a recent development, shall we say, is the return of student loan debt and payments. So the Trump administration has reversed the Biden administration's pause on student loan repayments. A lot of people, understandably, are very concerned. This is from The Guardian. They've interviewed some people who says that they're already missing loan repayments and they cannot afford this. And now, all of a sudden, this colossal debt that was previously pardoned is now coming back. How is this going to change consumer spending, do you think? Have you surveyed people about this issue?
Yes, we did. So we asked consumers in July. First, we asked them, do you still have an outstanding student loan or not? And for the ones who had the student loans that they had to service, we asked them about whether they were concerned about the recent changes in the loan program to affect their ability to spend. And almost half said, yes, this is going to affect my ability to spend. We asked other questions about whether it could affect their ability to take new loans, to service the other loans. And we had between, I don't have the exact number, but between 35 and 40% saying yes. And also, if the payment they need to do for the student loans affect their ability to service the other loans, it's a potential way of, the delinquency to spread to some other credit lines. If consumers, because they decide, okay, I'm going to pay the student loan, then I can't pay the other loans. So it could kind of spread the difficulties across the financial system. They're also concerned about their credit scores because, for the past 5 years, if you didn't pay your student loans, it wouldn't affect your credit score. Now it's going to affect your credit score and your ability to take new loans. So these are things that are worrying consumers. However, you asked me about, the impact on consumer spending. This is not affecting every single consumer in the economy. It's you have less than 20% of the U.S. population who has a student loan to service, so you already decline, and not of them are in default. It's just another headwinds to, it's adding to the headwinds to consumer spending. Alone, if it was the only thing that's happening in the economy, it wouldn't have much of an impact. Because there are more things happening in the economy, because consumers are worried about inflation, because we have the impact of tariffs, because we see the labor market cooling. This is just adding to the other factors.
So overall then, given all the surveys and indicators that we've looked at so far, how would you and your colleagues assess the financial conditions of the average consumer now and into the end of the year? Do you expect improvement, deterioration, or no change?
Between now and the end of the year, we are still waiting to see the impact of tariffs feeding through inflation. This is affecting consumer finances. We don't expect a major deterioration of consumer finance this year. I think, we are watching what the Fed is going to do. We see a potential for a cut towards the end of the year as the economy slows. So we know that, debt is high, but it's still manageable and consumers still have income. As long as they have income, as long as they have jobs, they're able to continue servicing their loans. So we are not necessarily concerned so far.
I know this is very difficult to assess, but generally, how often are consumers actually right about their own expectations versus incorrect?
That's hard to say. I think the question is not whether they are right. The question is whether they act according to their feeling. And it seems, they're worried, but they still spend. They're worried that they're worried about the economy in general. They're worried about inflation. But they have been spending for the past 2 years. They were worried 2023, 2024. They were worried about the economy. They were spending. So it's more like it's an internal, discrepancy between what they say and what they do. Because a year ago we had the survey. We asked them, interest rates are high, inflation is high. are you going to save more? They said yes. Then we did look at the inflation, the consumption data. Consumption is up. So I think that's where, that's what makes it difficult to assess.
Yeah, that is interesting. Maybe it's not the same people that are spending money versus the same people surveyed. Is that possible? Maybe this will segue into our last part of the conversation.
We have a very good representation of the U.S. population in our survey, both in terms of age, in terms of income, in terms of geography. So I think this is representative of the American population.
Well, let's end on this note. How is the survey conducted? Just high level, what is the methodology?
So it's an online survey. We are working with the partners. They have a huge panel of U.S. consumers, and every month they survey 3,000 of them. So we are trying to avoid the same people responding every month, so that we take a different sample every month. We publish preliminary results towards the end of the month, before the month is finished. So when we publish, it's a preliminary assessment, and then we add, the last week, and we get the final, and that we publish with the next month's release.
Okay, I understand. Thank you very much, Stephanie. Tell us more about where we can find more information about the Conference Board and your research.
You need to go to our website. Just Google Conference Board, and even better, if you Google Conference Board consumer confidence, you will find us very easily.
And roughly how many people are represented in the survey each month?
Well, 3,000 consumers. But it's a representative sample of the U.S. population.
Yes. So, all right, we'll put the link down below, and we'll see you next time, Stephanie. Thank you very much for your time today.
Thank you.
And thank you for watching. Don't forget to like and subscribe.